Here is a number that, by the old rules, should be impossible. When $1 of new money flows into the stock market, the total value of that market tends to rise by roughly $5. Not $1, about 5. A dollar in $5 of value created out of thin air. For decades, the standard theory said this could not happen, because rational investors would always step in and trade the mispricing away. This is the story of the idea that says it does happen, and why it quietly rewrites how we read every rally and every crash. Here is why this matters, even if you never place a single trade. The classic picture of markets says prices simply reflect information. News arrives, prices adjust, and just shuffling money around does nothing, because for every buyer there is a seller at almost the same price. In that world, a giant pension fund moving $100 billion into equities should barely nudge the market, because a crowd of flexible investors stands ready to take the other side. The inelastic markets hypothesis says that picture is simply wrong about the real world. In practice, large flows move prices a great deal because the people on the other side are not standing ready at all. That one change in assumptions explains something the old model struggles with: why markets can lurch violently on days with no real news. Let's build this one block at a time, starting with a single word: elasticity. It just means how strongly buyers and sellers respond to price. In an elastic market, if the price ticks up, plenty of holders happily sell, so new demand is met with barely any movement. Now look at who actually owns most shares today. An enormous slice sits with index funds, pension funds, and insurers. An index fund does not sell because prices rose. It tracks the index no matter what. A pension fund holds a fixed split, say 60% in stocks, and rarely drifts far from it. These giant owners are, in effect, frozen in place. So when a fresh wave of money arrives wanting in, there are surprisingly few willing sellers to meet it. Demand is inelastic. To clear the market, the price cannot just nudge. It has to lead. In 2021, economists Xavier Gabix and Ralph Koijen measured exactly this and put a number on it. Every dollar of net flow into equities pushes the aggregate market up by around $5, with estimates ranging from about 3 to 8. So the real question becomes, what does a multiplier like that do to the market you live in every day? Here's the machine itself. When money flows in, it has to buy shares, but the largest owners will not sell, so that buying runs straight into a wall of unavailable stock. The only way to coax out enough shares is to push the price up sharply. Now comes the second-order twist, and it is the heart of the idea. When the price of a share rises, the value of every share already held rises with it. So a relatively small inflow, forced through a market of frozen holders, revalues the entire pie at once. That is how $1 in can add around $5 of market value. Now run the film backwards, because this is where it gets uncomfortable. The same mechanism works in reverse. When money flows out, there are just as few willing buyers, so the price has to fall hard to find them, and the whole market gets marked down by a multiple of the outflow. The market does not tell careful selling apart from panic selling. A dollar leaving can erase several dollars of value on the way out, block by block, the mirror image of the climb. So where do you actually see this force at work? Think about the last 2 decades. Trillions of dollars have migrated into passive index funds that buy and hold no matter the price. By the logic of this idea, that structural shift alone can lift valuations, because it swells the pool of frozen holders and shrinks the pool of willing sellers. It also means the market has grown more sensitive to flows over time, not less. Corporate buybacks, monthly retirement contributions, one giant fund rebalancing at quarter end, each is a flow, and each gets multiplied on the way in. The people who feel this most are ordinary investors who assume a calm market must be a safe one. Under inelastic markets, calm can be an illusion manufactured by steady inflows. Let those inflows merely pause, and the very multiplier that inflated prices on the way up can work just as hard on the way down. The estimates are not precise to the dollar, and that is the honest caveat. The multiplier sits somewhere in a wide band, but even at the low end, flows matter far more than the old model allowed. So here is the lens to keep. The old view says prices move on information. The inelastic view says prices also move powerfully on flows, on who is forced to buy or sell, and how few people stand on the other side. Both can be true at once. The real question is which force dominates right now. When you see a market grinding higher on no obvious news, it is worth asking who is being forced to buy. When you see it sliding with no fresh headline, ask who is being forced to sell and how thin the other side has become. This does not tell you what happens next, but it reframes the market as a machine moved by flows, not only by facts, and that is a sturdier way to see it. This channel explains how markets work. It is educational, not financial advice.